Your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking a little bit about estate planning this morning. I want to get into some other areas, though, to start the show, mainly as far as the market. We had, of course, the Fed meeting here recently. With that, as we expected, the 75 basis points increase in interest rates. So what we're wanting to do now is think in terms of the effects of that. Of course, we saw the market initially kind of swoon a little bit. When we look at that on the year-to-date basis, we've got the S&P 500 index at a negative 22.45%. The Dow Jones at a minus 12.53. Now, by the way, 22, right? That's over 20. So we're talking, as we've been in this year, basically a bear market. It's kind of come in and out of that bear market territory. But for the most part, this is one of the concerns going forward. What's it going to do for the rest of the year? By the way, the Russell 2000, which small caps were giving us a much worse year, basically, or having a much worse year. They have kind of caught up a little bit because initially the return on the small caps was lower than that of the large caps, the S&P 500. But now they've evened out. The negative 21.69 on the Russell 2000. Nasdaq minus 34.67. So we're seeing how tech has been even more impacted by the market this year. And of course, interest rates having a big part of that. And in the AGG, the bond aggregate bond index is down 16.73. And this is another thing when we're looking at the markets as a whole and in general here, one of the things that we have to keep in mind is that when you're looking at stocks and bonds, usually when stocks are down, bonds are going to help protect you against that down market. All right, but here we're seeing that the bond market is down more than the Dow Jones Industrial Average. So it's a very unusual period of time. And when we look at treasuries, long-term notes, those are way down as well. And we're seeing, of course, our 10-year and our 2-year with an inverted yield curve. All of these things are indicating that things are likely to get a bit worse before they get any better. So one of the things that we want to think in terms of, this is a good time to reassess where you're at in the market and just, are you properly positioned? If you've got some holdings there that maybe aren't going to do as well, even in a rebound, you might want to, in fact, you definitely would want to at least take a look at your asset allocation model, see if there's some things that may be a good time to get rid of and reposition a little bit to prepare for when the market does turn. I don't think we've hit bottom yet. I'm hoping that it'll happen this year, meaning, sometime, let's say maybe by the next Fed meeting even, we might have some news that could help with that, but it could roll into the first quarter as well before we hit that bottom and get back on solid ground. All right, so all of this to say, this is a great time to take a look and have your portfolio analyzed, see how well you're positioned, and see if there's some things you want to do differently. If you'd like some help with that, you can call my office. That number is 615-376-5325. If you call the office, you can get the comprehensive financial plan at no charge to you. And what that's going to do is, among other things, is an investment analysis. All right, now, when we're talking about a comprehensive financial report, if you will, and an analysis of what you're doing for taxes, what you're doing as far as your investments go, talk to you about safe money alternatives, talk about long-term care, we get into Social Security, Medicare. It covers about everything you're going to need to take care of when you're retiring. There's a lot of complexities and a lot of decisions and choices that come with reaching retirement age. When do I take Social Security? Do I take it as the earliest, being at age 62? or do I wait till my full retirement age, or do I wait even to age 70 and get those delayed retirement credits? All of that depends on your individual situation. Medicare at age 65, is that the right time? Again, are you going to be working past age 65, and how is that going to play into those choices? Anyway, if you'd like to get this report, 615-376-5325. When you call in, we're going to get your information, send you out a checklist of things to bring to your appointment. We're going to be looking at your income, your assets. We're going to look at income expenses, assets, and liabilities. So on the income side, of course, we're going to factor in for cost of living adjustments. We're going to factor in for taxes. On the expense side, we're going to factor in for inflation. Of course, a big buzzword these days. When you're looking at inflation right now at over 8%, and I've got a chart. If you'd like to get a copy of this, by the way, I'd be happy to share it. And again, if you call the office and ask for the historical inflation chart, we can send you that. And it's kind of helpful to give perspective, to understand that though we've had double-digit inflation in the past, so we've had high inflation in the past, it's not something that lasts that long, okay? In other words, numbers that we're seeing right now, it's not to say that that's a permanent thing, certainly, and it's, for that matter, typically, and I expect that by next year, those will be, if not by the end of this year even, starting to come down some. All of that being said, again, you have to be thinking more long-term when it comes to your planning, and not get too caught up with the immediate of what's going on, but be thinking more in terms of what is this going to look like for me over the next 5, 10, 15, 20 plus years in retirement. So again, inflation is one of the things we look at, rates of return on your money, and help you determine what is the needed rate of return on your money to be able to accomplish your financial goals. First and foremost, we want to be able to attain and maintain our standard of living and quality of life no matter how long we live, never have to worry about running out of money. And again, not just about surviving retirement, so to speak, not just by just getting by. We want to thrive in retirement. We want to have the necessary resources there and manage those resources in such a way that we never have to, again, worry about running out of money, but also to have fun money, right? When every day is a weekend, when you retire and you no longer, I mean, think about it, when do you do most of your leisure activities, right? It's on the weekend. So now imagine you're not working anymore and every day is a weekend. You get more time for leisure activities, plus maybe projects around the house, different things you're going to be doing. So if anything, you're likely to see, especially in the initial years, your expenses go up in retirement. Maybe you're going to start, traveling. Maybe it's about checking off a bucket list of some sort. Whatever it may be for you, understanding what the needed rate of return is to accomplish your goals, then putting an investment plan around that, right? Looking to manage or minimize risk in the process. So all of that is part of the planning. So just call my office again, 615-376-5325. Like I said, we'll get your information. We'll send you out that checklist. It's going to be, typically 2 or 3 visits, again, at no charge, though. I'll help you see what your financial future is based on what you're currently doing. Okay, and then share some strategies with you to help improve that. And by the way, when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. Okay. We're going to be getting into, besides the markets and besides the thing that, when it comes to getting ready for retirement and developing, you're going to be going from this growth plan, if you will, right? When you're saving up for retirement, it's all about growth. We're not going to touch that money. We just keep pumping money in every month, every pay period, just to build those accounts up. And when we have a down period like this, we don't really worry about it. We just keep buying because share prices are low. That just means we're getting more shares for the same amount of money. When the market turns and heads back up again, we're going to really benefit from that. However, now that when we're heading into retirement, that planning changes a little bit. We go from worrying about growth, right, to where, we're going to start taking money out now. We're going to need income from those accounts. And when you're taking money out and the market's down, that can be problematic, right? We've talked about it before. Sequence of returns risk is what it's called. And basically what it means is if you're retiring into a bear market such as this one, and you're starting to take money out of those accounts, that could be detrimental, because basically now you're having to sell more and more shares because the price on them is lower to get the same amount of money. Now you're going to have that reverse effect. When the market bottoms and heads back up, I got fewer shares, I'm not going to bounce back as quickly. So again, positioning then your investment plan, one, around that changing reality, but also thinking in terms of income when it comes to retirement. Okay, so what we're talking about now is we want to think in terms of a tax-efficient income stream that not only is going to take care of us through those retirement years, maintain, again, our standard living, get that fund money in there, but also when it comes to your income, making sure that no matter what's going on in the market, that income stays stable, and in fact, it's increasing with inflation at the same time. It's a lot, but we can do it, right? All right, we're going to take a break. Join us here. We'll be right back on the Retirement Report.